Hi guys and welcome back to Yashi today with another CPI report video. This is the actual CPI report video. We made a forecast a few days ago. What did we say during the forecast? We saw food prices starting to decrease. We saw gas prices starting to decrease, but still prices were pretty stable. Fast forward today. The general result is pretty much what we talked about in the past video, which is inflation has been dropping compared to last year. Dropping, I mean, slowing down is still very high. We are at 6%, but it is increasing if we look at the trend, for example, from January. So the report before this one here. Generally speaking, the report is not positive and not negative. It's pretty neutral. If you want to play with the rhetoric, you could say that there is a downsloping trend in terms of inflation if Powell were to speak. So we cannot really forecast what Powell will do. We're going to talk also about some other factors, what happened with banks in the past couple of days and how this might affect Powell's decision in the next couple of weeks. Let's get started here. If I click record in 3, 2, 1 right here, we can see what I just mentioned. All inflation. So the report for February inflation is at 6% if you consider everything. 5.5 if we consider everything except for food and energy. The major drivers of all items were food, more than energy, which has been increasing a lot, with some factors decreasing. Some, for example, eggs, which were skyrocketing in the past couple of months because of the whole egg situation. Let's look into some of the details. Food in the past year increased by 9%. Specifically, food from home increased much more than food away from home, 10% against 8.4%. What went down? Energy commodities went down by 1% compared to last year. Fuel oil increased by 9.2%, but gasoline, so specifically for cars, actually went down. Energy services up 13%, electricity 12%, natural gas piped 14%. I have to look into this piped natural gas thing because if you look at trends on natural gas futures, they're actually downtrending. So I need to figure out this statistics a little bit more to give you more insights on this. Apparel up 3%, new vehicles up 5%, used car and trucks down 13%. This is one of the factors we were talking about in my forecast inflation CPI report a few days ago. It is down and it is reflected on the February report. Alcoholic beverages are up, tobacco is up, shelter is still up by a lot. Rent is up 8% and owner's equivalent of rent is 8%. So rent and ownership are starting to get closer and closer, probably because of interest rate. Buying a house now is getting more expensive. When we had a 3% interest rate, buying a house was almost a no-brainer across most of America. Of course, you always had those extreme cases like California and Washington where you had to play a little with the numbers. But with higher interest rates, it makes sense that the two are getting closer and closer. Trend-wise, we could still see that rent-wise, for many has been, let's say, a good thing to jump from their current leases to new leases as homeowners are offering lower prices on new leases. So the trends have been going down because of this factor. Will we keep that trend or not? That's for us to see in the future. Expectation-wise, and this is what I take now from the Clear Value Tax YouTube channel, expectations are positive by everyday Americans. They believe that inflation will come down very shortly in the short term in 2023. However, their financials are getting worse this year. So there is the hope, but the actual situation is bad. Wage inflation is lower than actual inflation. It's around 3%, 3.2%, decreased by 0.1% in the last month compared to actual inflation, which is 6%, which means that real wage inflation is negative. People are making more, but it's not enough to offset the inflation in prices. So the general thought, the general thing is pretty negative. Now let's go into the banking section. SVB Bank and some other New York-based bank failed in the past couple of days. I always keep on forgetting the name of that bank in New York that failed. The fact is, the current situation and current interest rates, which let's say messed up many of the treasury investments of these banks, which were putting their money into these investments created a, let's say, dangerous situation for some of these banks. Maybe the bigger ones might have some more reserves, we're not aware of it. There are also some games that banks can play in terms of what can be done, what cannot be done, so we cannot always give the full picture. Fact is that we're seeing some lack of resilience in the banking sector. And what this means is that people are expecting the interest rate increase by the Fed to slow down or even stabilize. We see this reflected very well here in mortgage rates, which went from 7% and above in February all the way to 6% in a matter of a couple of days. So right here, this is a drop that happened in a few days. We're now at 6%, even under 6% when it comes to 20, 15, and 10-year mortgages. These are really good interest rates. Will we see a jump of home buyers back into the real estate market? We don't know that, because in all this, there's still a lot of insecurity, especially with what happened with banks very recently. Expectation-wise, what did the market expect from the CPI? What happened? The market expected a 6% inflation, and that's what they got. Previous was worse, so in terms of expectations, we're back on a trend where market expectations are being met by the actual data, which is good. How will the Federal Reserve react to the CPI report and what just happened with banks? On one side, banks are what helps driving the US economy, the US system. On the other, we have high inflation. Jobs report came in very good a few days ago. So from a jobs perspective, we know that the Fed would like to, I'm not saying would like to increase unemployment, but is okay with having higher unemployment to fight inflation, and the new report gives them more leeway to increase interest rates. On the other hand, we're also seeing a positive trend with inflation. Inflation is coming down from the 9% we saw in 2022, but it has an upward trend if we look at the data closer compared to, for example, the January report. Last but not least, we have the whole banking situation. So increasing interest rates is starting to become detrimental for banks and the investments that banks have. Could be the first example, SVB could be the first example of many other banks that could find themselves in a similar situation if their investments get penalized more and more by higher interest rates. Because banks, and I don't want to get too much into detail of this, kind of are incentivized to invest in treasuries. The problem is that treasury prices are very dependent on interest rates. The higher the interest rate, the lower the price of those treasuries in terms of valuation. And if you bought these treasuries 2 years ago when interest rates were zero, you're losing money if interest rates go up if you want to sell these on the open market. So this is a tricky situation. Would you sacrifice the banking system, aka entire America, fight inflation? Are you okay with the current inflation, or are you okay with the current state of things? Are you okay with increasing unemployment? There are many factors involved. The fact is that the market is pricing in stabilization or a small increase in interest rates on the next Federal Reserve meeting. We will see that. Last but not least, and this is my personal opinion, I believe that the Federal Reserve did everything they could in terms of fighting inflation, or their part of inflation, which is the money printing we saw in the past couple of years. I believe that most of the inflation we see today is a direct consequence now of consumption, people consuming still too much, and supply chain. Good example is fuel prices because of what is happening in Eastern Europe, which is taking away supply from the whole fuel market, also from the wheat market. Ukraine selling food. I'm sorry guys, I'm Italian, so it can happen sometimes. The fact is, we're having a lot of supply chain issues. And another one is, of course, the lack of people who are looking for a job, which is creating problems in terms of employment. If we have too much competition among businesses to hire people and too little people to be hired, it could create some constraints, supply chain issues, and not enough people working in the industries that are affected by inflation the most. Guys, this is all for now. I'm not really giving you a forecast here. I'm simply stating some data. This is not financial advice, and always do your research. This is simply me giving you some data, what I find around, and giving a little bit of my opinion onto it. Let me know what you think. Let me know if your situation is better or worse this year compared to last year, and see you on the next video.